Well, hello everyone, and welcome to Charting the Second Half, a StockCharts mid-year perspective. I'm Joe Duarte, founder of Joe Duarte and the MoneyOptions.com. It's my pleasure to be here. I want to talk to you about taming the uncertainty of this wild and woolly market. Thanks for joining me. Over the next 30 minutes, I'll be discussing the ins and outs of this complicated market from multiple perspectives, focusing on the most telltale charts with both a historical perspective and a bit of predictive value, with the real goal of helping us all to decide which way to trade this market over the next 6 months. So let's get started. We're looking at a difficult market here. Look at these influences currently. We have COVID-19, a crazy pandemic. We have a recession that's clearly related to the COVID-19 pandemic. We have this election that is, what can I say? It's remarkable, to say the least. We have social unrest. We have a Federal Reserve that is printing money like there's no tomorrow. And of course, we have a great degree of market volatility. So how do we make sense of all these things? Well, first, let's have a look at the big picture and let's get our bearings. And then slowly but surely, we're going to peel this banana and see what we can come up with. So as always, I like to start with my favorite indicator, the advanced decline line. Of course, those of you that are familiar with what I do are aware now that I use the advanced decline line because the algos can't tweak it and distort it as much as they can the indices and individual stocks. So quick overview here. We have the complexity zone, and that's where stocks do well. That's where the forces of the universe are positive and market prices tend to rise. We have a chaos zone where everything is bad. There's disorder and things are going crazy. And we have the edge of chaos, which is where the balance between complexity and chaos is just right to make stock prices go up. And you can see briefly here that periods where the stock market goes below the 50-day moving average, as measured by the advanced decline line, can cause significant amount of trouble, which is made even worse if it goes below the 200-day moving average. And of course, what I call the 50-50 rule, which is hugely important. That is where we have the 50-day moving average being broken at the New York Stock Exchange advanced decline line, and as we just saw on June 26th, the RSI falling below the 50 area. That's a problem. And if this continues, then we're going to have further problems. The next support as of today is the 50-day moving average for the advanced decline line. But it gets a little bit darker, and I'm not trying to be negative, but we need to be aware of these things. This S&P 500 closed below its 200-day moving average today, which is significant. So that means the S&P 500 is now at the edge of chaos. If we want to focus on this closely, we can see that this is an area that has been essentially fought over for about the last week or two. And so far, the S&P has been able to bounce back. But what you can see here that's troubling, and it could have a great deal of bearing over the next 6 months, is that accumulation distribution has suddenly began to look down. That means people are actually selling into this, even though it's not too aggressive because on-balance volume is still on the neutral side. Nevertheless, the market's losing momentum. We look at ROC, now it's below zero. And of course, the 50-50 rule, which is that the RSI is below the 50 area, although the S&P 500 is still above the 50-day moving average. Quick look at the NASDAQ 100 in order to confirm our S&P 500 analysis. Similar picture, but at a different level. We have plenty of room here for the NASDAQ 100 to stay in a long-term uptrend because it's still above its 50-day moving average, although it's dropped below its 20-day moving average. 200-day moving average is quite a way off, so that's not necessarily a problem at this point. Again, accumulation distribution is flat, unbalanced volume is flat, but momentum has been lost and is still not below the 50 area on the RSI. So now that we know what's going on right now, let's look at the historical perspective of this thing. And I want to look at the presidential cycle briefly. So we're going to start with 1968, where we had a flu pandemic. It was an influenza A strain. It started in September 2018. Look at this. We had 1 million deaths worldwide, 100,000 deaths in the U.S. And most deaths were in people over age 65. And of course, this comes from the CDC. Similar statistics. But you want to see what the market did in that period compared to what it's doing now. This is President Johnson's second term. He had, of course, a half a term or so when President Kennedy was assassinated. I want to spend some time looking at this period of time here that we have a circle. This is the early part of the year. We saw a decline in the market at that time, which recovered. And by the end of the year, it was moving significantly higher. And we can see that the commodities were flat, and so were the yields. The key to remember is this decline, this recovery. Now let's move forward a little bit here and look at President Obama's first term. Again, a decline in the market in the middle of the year and a recovery. And again, similar characteristics in 30-year bond yields and commodities. So let's look at Trump's current term. And guess what? We have a significant decline in this case in the middle of the year with a rebound. The key now is what's going to happen here at this 200-day moving average. And as we go through this presentation, we're going to try and make sense of this. So the key to the whole thing throughout all the presidencies, whether you like to believe it or not, is the Federal Reserve. And so I have a long-term picture here from the St. Louis Fed. And just briefly, this is 1968 right here, circled. Guess what? The Fed lowered rates during that decline that we saw in Johnson's term, and the market rallied. Of course, they raised interest rates later. The key is that period. Same thing with Obama. We had the 2008 subprime crash and everything else, and interest rates stayed below zero. So the tendency of the market was to rally. And of course, now we look at Trump's term and interest rates are zero again. So if history holds up, you can say that on the plus column, the Federal Reserve's actions could actually forestall a major decline in the second half of the year. Although that is not certain, but certainly history suggests that it's possible. So what's the Fed doing right now? Interesting chart here. This is the S&P 500, the orange line above. These bars are billions of dollars that the Federal Reserve is injecting into the market as a result of the current economic environment. Real quick, August 2019, these are actually monthly numbers here, but you can see the general tendency. The Fed pumped more money into the bond market, S&P rallied. Then things got dicey. Guess what? The Fed started pumping less money. Things got crazy. COVID-19 hit, and the Fed eventually just put a ridiculous amount of money in the market, $300 billion, market rallied. Guess what? The Fed is starting to taper the amount of money it's putting in the markets. The stock market is starting to fall. That's an important point to keep in mind as we look at this market over the next 6 months. So let's look under the hood here. Okay, we're going to look at some specific sectors of the market, and we'll see where we might be able to find some light. First, let's look at what winners were in the first half. Yeah, consumer discretionary, home builders, technology, biotech. We had a lot of losers. In fact, more losers than winners. We had energy, financials, aerospace, industrial, transport, utilities, and real estate investment trusts. What's gaining momentum right now? Well, it's hard to say because the market's starting to roll over. But theoretically speaking, and if we look at things over the last week or two, of course, it's late June right now, but nevertheless, this is our benchmark. We see a technology, biotech, to some degree, robotics and software have actually been gaining. But look at the number of losers. It's just an outrageous amount of sectors that are not doing well. And I want to point out especially energy, the big pharma, and the utilities that have just done terrible. Furthermore, the home builders, which did well in the first half, are starting to have trouble. So that's another situation that we need to look at. More sectors seem to be falling than actually gaining ground. But we want to be hopeful here, so we're going to look both ways. So first thing we want to do is look at biotech. And you can see here that biotech is as represented by the iShares NASDAQ Biotech ETF. Had a terrible COVID-19 period, recovered, and is actually at the current moment trying to break out. So is that going to happen? Well, it's possible. it's actually a lot more possible than we may realize. Accumulation distribution is very good, rising. Unbalanced volume is rising. Momentum is relatively flat, but not completely falling. And RSI is above 50. But here's the important stuff. It's still above the 50-day moving average. Perhaps with today's decline, things might get a little bit dicey, but nevertheless, above the 200-day moving average. And my tiebreaker indicator, volume by price, says that if this index or this ETF can stay above this 135 area, where we look at this relatively big bar, which signifies support and resistance, if it can stay above here, we can get this thing much higher because the big support and resistance areas are way down here. So technology, very similar picture. Again, the take-home message here is that a big recovery with a not so robust decline. The key is to watch that 50-day moving average, that 50 area on RSI, and again, accumulation distribution, unbalanced volume, and ROC, which tells us momentum. All these things are telling us that right now, today, it's not so bad. And here's the key. Volume by price, small bar, which means that there's no resistance. That means that if it holds, then we can have a great up move. So you can't discard technology at this point. So let's look a little bit deeper. Here's robotics. And yeah, if you look at this chart from a global standpoint, you're gonna say things looking pretty good. But if you start looking under the hood, you can see that accumulation distribution is starting to fail a little bit. Unbalanced volume, it's okay, but it's flat. And we have a break below the zero line on ROC. And we could be getting close to that 50 area down here on the RSI. And here's the big problem. You got this huge bar down here, which tells us there's support. You got almost the same bar up here where this resistance is on volume by price, which means that what we're likely to see is not necessarily a complete breakdown in robotics, but perhaps a sideways market here for a while. So this would be an area to keep an eye on, but not necessarily an area that you want to start plunking a lot of money into. Software, on the other hand, this is like a COVID-19 dream. These are the inner workings of the market in the sense of these are the products that people are using to work from staying as they stay at home. So software has had a huge rebound and it continues to be accumulated. It also continues to have good unbalanced volume. ROC is above zero. RSI is closer to overbought than oversold, than sold out at 50, which means that at this point, what we have is a market that is likely to hold up better than other sectors. And again, our tiebreaker indicator here, the volume by price, tiny little bar over here with decent support in this area. So low resistance and decent support, which means that if things get ugly, software might be a great place to buy on the dip. So let's look at some characteristics of some winning stocks in this market and see if they're going to serve us for what lies ahead. So you have the winning stocks here are really companies that have provided benefits during tough times. And COVID-19, unfortunately, is not likely to go away anytime soon, so times are likely to remain tough. So we want to look for companies that do well under tough times. So here's a good momentum stock in the consumer discretionary sector. Medifast. This is a company that makes diet foods and provides coaching to people that are losing weight. Recent surveys showed that 30% of Americans have actually gained weight by staying at home. And guess what? The stock has rocketed. And it's actually near its 52-day high, especially on a day like June 26, where the market fell 700 points. This stock was up $1. Now, full disclosure, I do own this stock, and I did recommend it at joeduarte.com near the $110 area. So we're up about 20% at this point. Nevertheless, let's look at this thing. So you have a company that provides products and support to people that are trying to lose weight during a very stressful time. That's your recipe for success in a market where times are tough. So let's look at this a little more carefully with the usual indicators. Accumulation distribution has just turned up. That means that people are finally recognizing that this stock is doing well. Imagine that. People are starting to recognize it right now as it's just breaking out and taking off. That suggests that it could go significantly higher. Again, unbalanced volume, which very nicely turned up well before accumulation distribution, was telling us that money was moving in. ROC, well above the zero line, and it's a little bit overbought now, but that doesn't mean that it can't continue to move higher over time, especially since volume by price is telling us that there's almost no resistance overhead. So here's a stock of a company that is actually benefiting from tough times because they are able to provide services that people need during difficult times. Same thing with eBay. eBay is essentially becoming a significant place where small businesses can make transactions online with customers and with other small businesses. It's no longer an auction site. It's actually a commerce site. And the company has done a great deal of restructuring and all kinds of things to make its platform more user-friendly. And they're being rewarded for it. So let's look at eBay real quick again. Same kind of routine. Accumulation distribution, flat, but not terribly bearish. Unbalanced volume, consolidating pattern, which is what we're seeing here. And ROC just turned up, which tells us that the stock is picking up momentum. In fact, on June 26th, when the market was down 700 points, eBay actually delivered a near 52-week high. It's a little bit overbought, but nevertheless, again, a company that is delivering products and services that people need during difficult times to continue their businesses. So let's figure out what's next. Okay, I have some dark horses, and these are the sectors that could go either way in the second half, and much depends on all those factors we talked about, especially what the Federal Reserve does and how the economy responds. One of the worst hit sectors of this year has been energy, and so I want to look at actually crude oil prices. We see that they collapsed, and it's amazing that prices went down to $7.50 earlier in the year. And of course, everyone remembers that crude oil futures actually went below zero, which is really remarkable. Nevertheless, crude oil has bounced. But is this something that we want to get into? I don't know. Accumulation distribution is pretty fair. Unbalanced volume is pretty fair. But look at this. Momentum is at zero. That means it's actually losing steam. And you can see why here. You got huge overhead resistance with the 200-day moving average and this big volume by price bar that is going to bring in a lot of sellers into this market. That's an area of the market that you want to be concerned about. Let's look at the oil stocks. They look even worse. Now you had a big bounce, big rally. A little bit of money came in, but it's starting to fade. Accumulation distribution is falling. Unbalanced volume is flat. ROC is below the zero line, and RSI is below 50. Plus, you have this huge resistance bar up here. You have a 200-day moving average. It's going to take a lot for energy to recover, and it's broken the 50-50 rule. You have it trading below the 50-day moving average and below RSI of 50. I want to look a little deeper, because gasoline is actually in a different position than crude oil. You see gasoline prices have recovered, huge accumulation distribution, huge unbalanced volume, and now you have a flat ROC, which tells us that we're in a consolidation point. But RSI is well above 50, which means that consolidation is the most likely scenario here. But you might actually see gasoline move higher if things get a little bit better for the economy. Here's the opposite side, transports. They use gasoline and crude oil related products to move trucks and cars. And you can see that the transports are not liking those higher oil prices in the current environment. So that's something to keep an eye on, because it could mean a whole lot for the economy going into the second half. And again, we're getting very close here to breaking that 50-50 rule with the transports. You can see the 50-day moving average is about to give. RSI has already given. ROC is below the zero line, and you're starting to see a downward trickle in accumulation distribution, as well as unbalanced volume, which is now flat. Got way high levels of resistance here. You got 20-day moving average, 200-day moving average, and you have a lot of volume by price resistance. So you want to be careful with those transpos. Now, let's look at some bullish things with some dark horses. Here's a biotech stock called Repligen. And Repligen is actually an interesting company because Repligen makes the things that other biotech companies use to make their products. It makes machines and it makes reagents. And as a result, the stock has recently broken below the 50-day moving average and the RSI. But guess what? It's starting to pick up, which means that there's interest now in this stock at these levels. So people are actually buying this dip. And it looks to me as if they might be successful. Because look, accumulation distribution's up, unbalanced volume is up, and there's no major resistance levels in volume by price. So there's a dark horse that might actually turn out to be good. So we have the bottom line here to think about. We have the presidential cycle, we have the Federal Reserve, and we have COVID-19. There's a lot of uncertainty because of all these things. So how do we manage all these things? Well, it has some sound trading principles that I've spoken about before, but that I think are crucial because they ground us and they keep us focused on doing the right thing. So first thing we want to do is stay with the primary trend. And if what happened today on June 26th, where the market was down 700 points, if it continues, then we're going to have to stay with that primary trend and consider that the trend is no longer up but down, which means we're going to have to act accordingly, and that means we might have to sell some stock. We might have to consider going short. Keep an eye on the 50-50 rule, 50-day moving average and RSI of 50. Those two things are not in your favor, then you want to be much less involved with stocks. If they turn up, then you want to be buying stocks. You want to fight the Federal Reserve, but you don't want to fight the market or the market's momentum. So the Federal Reserve is going to have to increase the amount of money that it puts into the bond market, or the stock market is not likely to fare as well as it would otherwise. I'm always big on keeping position sizes small. If you're trading 1,000 share lots, the volatility in your portfolio is going to be much higher than if you trade 100 or 200 share lots. Take profits when warranted, meaning that you get a 20% pop in a stock and you got 200 or 300 shares, take half of that position off. You've made some money. There's no reason to leave it there for the algos to take. You always want to be looking for new stocks with excellent charts and sound management. Think of companies like Repligen and Medifast. What are they doing in this market? What are their products? What's management doing? And most of all, what the charts are telling you. Furthermore, manage your sell stops. Stock goes down 5 to 8%, you probably don't want to be in it. Does that mean you don't want to own it when it improves? No, it just means you don't want to be in it at the moment because you don't want to take those losses. Always want to prepare for when the music stops, because when that market turns lower, it's going to go down fast. So in conclusion, it's safe to say the next 6 months should be interesting, to say the least. But if we're armed with technical analysis and sound trading principles, we should be able to weather the storm. I'm Joe Duarte, founder of Joe Duarte and themoneyoptions.com. You can catch me often on your Daily 5. You can read my articles on my website, Joe Duarte and themoneyoptions.com, and weekly on StockCharts.com. Please consider my books, Trading Option for Dummies, Market Timing for Dummies. And to have daily access to my stock picks and the latest market information, consider a free trial to Joe Duarte and themoneyoptions.com. I have some full disclosure. I own eBay, Medifast at this point. Please have a happy and safe, profitable second half, and we will talk again.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.